discussed the idea of CVA and illiquidity adjustments. So now let's try to understand what do we mean by a capital charge for a certain product and why we require capital charge as well. So allow me to share my whiteboard. So let me take a plain, so let's say we start with fixed income first. Now, why fixed income? Because that happens to be the largest portfolio for any bank. So generally giving an idea of the way in which you'll see a fixed income capital charge report. Now, all of these are going to be standardized in the system because these are Basel requirements. So banks already have these things in place. However, it's always good that you know what these things are. So that's why we are covering this. So if you have to maybe interpret these things or maybe validate the result, you'll already know or you'll have some background as to what is a capital charge for a bond. So let's say I have just two bonds in my portfolio. So let me draw a small table. So let's say I have a bond 1 and I have a bond 2. And also draw one dividing line in between. Okay. So imagine that this is a report which I have downloaded from my system. So let me just complete the report first and then I'll tell you what these points are. Okay. Maybe PV01 if it adds value. Okay. So this is how you'll typically find a capital charge report inside any system. So take a Calypso, Murex, SAS, whichever you have. Now these things will generally be configured. So you'll have a ready report which will be generated on a daily basis. So maybe let me just fill up these things also. So probably this is SLR, so maybe AAA. Let's keep it as AA and some values here. Okay. So I have two bonds in my portfolio. That's it, B1 and B2. One is a government security, which I call as the SLR, and second is a non-government one, which I call as a non-SLR one. Face value, I could just take it as 100. I have some market value. So imagine that either these bonds are liquidly traded or I have a certain model through which I'm trying to calculate the bond price, which I represent by MV. Now, ratings I have kept it as AAA safely for SLR. For non-SLR, I have just made an assumption that it's a AA rated bond. Now, there'll be a certain time to maturity. So imagine these fields are filled as well. So something which has come in from your system. So let's try to understand these. TTM is easy, or your time to maturity. So standing today, how long you have until your bond matures. So that's what we call as the time to maturity column. Next, we have a duration metric. So the duration idea which we have discussed in one of our previous sessions when we spoke of fixed income. It is the same modified duration which we'll end up using. So we have duration numbers which will be populated. Then we have two columns which we call as GR and SR, which is general risk and specific risk. And this is something which go into your capital charge computations. Now your general risk and specific risk are a function of a few things. So, sorry, rather than PV01, let me write what I call as the CIY or the assumed change in yield. because that is something which will be useful. CY is the assumed change in yield. So general risk is also what you call as a broad market risk. It's a form of a market risk, or we also call this as maybe systematic risk. Whereas specific risk is something which we call as a idiosyncratic. This is this is not exactly a market risk, but maybe more of a non-systematic risk. Now, what do I mean by market and non-market risk is market risk is something which will be impacting every single bond which is transacting in the market. So that way, movements in, let's say, the bond yields, or let's say yields in the government securities market, that will have an impact on every bond, not just government but non-government as well. So that's why we call general risk as a broad market risk, or what we call as a systematic risk, which will impact everyone. But specific risk is something which is non-systematic in nature. That is something which will be applicable depending on the riskiness of that particular issue oblique issuer. Now, for SLRs, we don't really have a specific risk. So this will be zero because we don't expect the government to default. So the specific risk for government securities will be zero. But for non-SLR, you will definitely have a certain specific risk because there will be a certain risk which is peculiar for this particular non-SLR bond. And that is something which we try to cover through SR. So this is the brief idea behind GR and SR. So any questions on this table?
Sir, what are the parameters to be considered for GR and SR?
So for GR, so actually there's one more column which I need to add because something which will be required. You'll have a risk weight. So GR is a function of, so I won't write the exact formula, but the formula is there in the Basel guideline, but I'll give you the variables which are required. So market value, modified duration, and assumed change in yield. Now, assumed change in yield is something which is a function of your time to maturity. So depending on your time to maturity, Basel guideline defines what will be the value for the assumed change in yield, CIY, and that is something which we use in the GR bit. For SR, this will be a function of your market value, your risk weight, and anything else which I take. Not really. And there's a specific rate which we use.
So is that rate G6 security?
Not really. So that's like a more of a percentage number which is given as a part of the guideline. So let me also check out the exact formula for SR, but it will be there in the Basel III capital guidelines. So, but what I remember is both of these are functions of these items. So it's a straightforward formula. It's not very difficult, but you can definitely cross-check with Basel III circular so as to know that the exact formula to be used. Okay. So how much of portfolio management is covered in your previous subjects, or maybe is it covered now as a part of this trimester? So do you have anything on portfolio risk management, or maybe Markovitch portfolio theory, etc., efficient frontier, and other related concepts?
Yes, sir.
Yes, sir, we have efficient. We have had efficient.
Okay, okay. So good. Uh, so you must be familiar with the idea of portfolio risk. So imagine that I have two assets in the portfolio. So let's say X1 and X2. So let's say I just have a two asset portfolio. These are my two positions. Now I want, and let's say I have a risk for these assets as well. And so let's say these two are my assets, and my investment in these assets is, let's say, W1 and W2. So this is the size of my positions, and let's say sigma 1 and sigma 2 is the risk of these two assets. Now if I have to calculate the risk of the portfolio, uh, is this much information enough, or do I require something more? So can I use just W and W2, sigma 1, sigma 2, and use it directly in sigma p, or is it something else? So can I write it as W1 sigma 1 plus say W2 sigma 2? So would this be the correct representation, or is there something else? So was this covered as a part of your discussions earlier?
No, sir, this is not right.
Okay, so
So
what
we
more do
require
I need?
correlation coefficient also.
Very good, correct. So I require a sigma. Sorry, not exactly a sigma, more of a rho actually.
Rho.
So maybe a rho 1, 2. So this is that I require. Now, why I require this? Because there will be a certain correlation which these two assets have with each other as well. So that way, by simply adding up the risks of two positions will not be enough, because then what will happen is I'm simply double counting any kind of risk which I'm holding, and many a times it can happen that these certain risks will be offsetting each other. So in order to uh, capture that interrelationship between these two assets, I need to have this rho 1 2, which I call as the correlation parameter. So that way, if you recollect for your sigma p, you might have studied something like this. So maybe sigma p square. So you might have studied something like this. So this is how we calculate the overall portfolio risk, and this is how we try and combine the impact of systematic and unsystematic risk on a portfolio-wide level. So again, something specific to portfolio management. Can you so imagine that you are a portfolio manager. So as a part of your performance measurement, should you be compensated for taking on systematic risk, or should you be compensated for taking on unsystematic risk? So when I say compensated, should your bonus be dependent on the way in which you're handling systematic risk,
Systematic
or
risk, sir.
your bonus should be a function of the way in which you're handling non-systematic? Correct.
So
That's right.
because
So would you like
we
to
can
elaborate why systematic
we
risk?
can we can arrange the portfolios by taking the asset classes which help to diversify the risk which is associated with the systematic risk, not with the unsystematic, because they can't be in our hand and we cannot haze from this, sir.
Okay. Correct. So just maybe rephrasing your response, you're right. A manager will be compensated only for taking on systematic risk. Now, why not unsystematic risk? Because this is a risk which can be diversified away. So when I say diversified away, if I can combine my portfolio of assets in such a way that I'm able to leverage the power of correlation, I can reduce non-systematic risk to a considerable extent. So that way, a manager need not be compensated for non-systematic risk, but for systematic risk, definitely, because that is the actual skill set for the manager. So if a manager is able to generate good returns, then they will be gauged vis-a-vis the kind of systematic risk which is there on the portfolio, because that shows the skill of the manager. So that basically explains how the manager is, and how and whether the manager is able to pick up the right securities for a certain investor, and that's how their compensation will be determined as well. So that is something which we call as systematic risk, and a manager always gets compensated for systematic risk.
Sir, can you please elaborate on the statement that non-systematic risk can be diversified? How will it be diversified, sir?
Because a non-systematic risk is something which is specific to a issue, right? So we are talking of specific risk part here. So something which is a specific risk, that is specific to a certain issue or a certain issuer. So that way we can combine issues in such a way that, or maybe we can have assets from different asset classes combined together so that I can eliminate that kind of systematic or idiosyncratic risk which is coming in. But I can't really say the same thing about systematic risk, because systematic risk is always there. Every security is exposed to that, and there's no way of getting rid of that. But for a non-systematic risk, if I can combine or if I can pick the assets in such a way that that systematic risk or specific risk to a certain issue or issuer is getting eliminated, then that is not really a separate skill, right? I mean, that's something which we expect from a manager to do. So that doesn't really explain uh, their strength around investment management. But that generally gives the idea that the manager understands that by combining these securities, we can get rid of specific risk. But finally, whatever returns are being generated, that will be driven by your active selection of securities, and that is going to generate the required portfolio return for you. So that's why a manager should be compensated only for the systematic risk and not for the non-systematic risk.
Sir, if I'm correct, please do correct me if I'm wrong. Systematic risk is the entire risk that are bonds subjected to, like economy or global risk,
Yes.
whereas non-systematic relates to a specific industry or specific company. Am I right, sir?
Specific company, I would say, yes. So when you say company, naturally it has certain industry-specific factors as well.
Okay, sir. Thank you.
Also, just a quick recap of a few things since we are on portfolio management. Let's see how much you guys recollect something which might be covered by your faculty previously. So let's say I have something like this. So a typical chart which you might have seen earlier as well. Expected return versus risk. So let's say I have a simple plot of expected return versus risk, and I have five portfolios which I have plotted. Let's say these are portfolios of all risky assets which I have access to, and I have labeled them from A through to E. Sorry. So out of this, which is my efficient frontier, or
B.
which portfolios are falling on my efficient frontier?
B, sir.
Only
All of,
B or something
all of
more
them,
also?
sir.
Sir, B to E. A is not an efficient
Yes, sir.
frontier.
B to E.
Okay, fair,
Correct. Very good. Yes.
fair.
So B to E is something which we call as the efficient frontier, or portfolios which fall on the efficient frontier. I just call it as EF. And there is a certain name which we give to A. So can you think of that name? So a technical name which we give to A, which might be covered in your portfolio management class.
Sir, I think it's the global minimum variance
Very good.
point or something.
Correct, correct. So global minimum variance portfolio.
But sir, the minimum variance is actually on B in this case, no?
Yes, sir. It's at B, sir.
So if you see the variance, we are basically looking at. Okay, here I mean this says, but I mean the diagram may not be in line, but generally this is what we call as a global minimum variance portfolio. Uh, Also, anything else which we can discuss on this, because these
So,
are certain. Sorry, yeah.
so I think Ali is right. I think B is the global minimum variance, leftmost
So
point available on the
mm,
efficient frontier.
yeah, yeah. So basically, A will be more of an inefficient portfolio.
Yes, sir. It is a easily dominated portfolio.
Correct, correct. No, that's right. Yeah, correct. Yeah. So I mean, thanks. Yeah, thanks, Ali. And rather than this, let's change it to B. So my mistake, my apologies. B will be the global minimum bit. And also, was the two asset portfolio discussed as well?
Yes, sir. It was discussed.
Okay. So the idea of two asset portfolio is basically giving an investor an idea of investing in a mix of risk-free and risky asset portfolio. So I think even the idea of tangency portfolio might have been discussed as well.
Yes, sir.
Okay, and possibly ideas of capital allocation line and capital market line also.
Yes, sir. But that
Yes, sir.
one was not very like it was not taught very not very intuitively, so it's a little shaky.
Okay, okay. So basically, the idea is a two-asset portfolio is something which we study as a part of the portfolio management idea. So let's say this is my risk-free rate, my expected return versus risk, and let's say these are my portfolios which I have. So as a two-asset portfolio, what we try to do is we try to plot a straight line through this and the tangency portfolio. Imagine this green line is touching here. So I'll just shade this in orange. Apologies, my diagrams are not very good, but imagine that this is tangent to this. Now, what we try to do is we try to combine risk-free asset along with portfolio A. So portfolio A is a mix of all the risky assets which are there available in the market, which I can invest in, and RF is the risk-free security, or what I can call as the government security. So generally, as a two-asset approach, what we do is depending on the risk perception of the investor, or based on what we call as the investor risk aversion. Investors will always want to invest a certain portion of their assets in RF and certain portion in A. So if we have people who are very risk averse, then they would like to stay in this area, orange area. That way, they will be focusing more maybe on RF, and certain investments will be in A. And those individuals who are willing to take on more risk, they may want to go in on the other side, because that way they may want to borrow from the risk-free market, and that is something which they can use for taking further leverage, or that's what adds to their leverage positions. So based on the investor's risk appetite or risk aversion, you'll see investors staying in this orange area or maybe the red area. And this is a brief idea behind a two-asset portfolio. Now, ideas of capital allocation line and or maybe capital market line and security market line. Now, security market line is something which is specific to a certain security, I would say. Now, what I've shown here, now this setup can be used to study a CAL or maybe a CML. CML is again just a special case of CAL where we have the tangency or the market portfolio which we use for analysis. Whereas for SML, your plot changes. So for your SML, you'll have expected return, and it will be versus. So what will be on the x-axis for an SML? So will it be sigma or will it be something else? Okay, so it will be beta. Because this is equity specific what we are trying to understand. So SML will be more of relationship with beta, whereas CAL or CML will be more of a portfolio risk. So here we are taking total risk into consideration. So when I say sigma, it is the total risk, your systematic plus non-systematic, whereas for SML, you have a risk which is specific to a certain equity, which we call as beta. So again, something similar might have been covered in your previous subjects as well. So I mean, this is just a few concepts which are related to risks, so that's why we are covering them. Global minimum is done, CAL, CML, SML is done as well.
Sir, can you expand on CAL and CML because this wasn't covered for IB?
Okay. So the idea of CAL or CML, which we call as a capital allocation line or capital market line, again, we study this many a times in conjunction with the two-asset portfolio which we have, which we just discussed some time back. So the idea of CAL or CML is to decide what kind of allocation of a portfolio for an investor which would be the most efficient for them. And when I say efficient, you need to take into consideration the investor risk perception also, because not every investor is risk taking. Many times investors can be conservative. So that way they would say that we want more amount of investments in the risk free and maybe some amounts in a risky portfolio. Whereas you may have certain people with an entrepreneurial mindset who would say that fine, we are willing to take on more risk if there is a probability that we can generate higher than or maybe a higher return. So based on that, you try to plot investors along a line which we call as a capital allocation or capital market line, I would say. Now what we do is we pick a tangency portfolio. So here A is what I'm showing as the tangency portfolio. Now why I say tangency portfolio? Because this green line is tangential to this orange curve which I've shown here. And this this point at which it is tangent is the point whereby the slope of the line is the highest. So when you say when the slope of the line is highest, that means the expected return is also supernormal here. So when I say supernormal, I'm not saying something which is very high, but that is the most optimal return, what I can say, because it is the point of highest slope. So generally, highest slope will help us understand the point of highest return. And based on that, I'm going to try and combine my portfolio, which will be a mix of risk-free asset plus certain position in A. Now, I have shown RF on this axis directly. So, uh, so why I have shown this? Now, why can I show RF via this point in red? Now, why don't I show RF somewhere here on this circle dot? Why do I show RF on this line? That is, let's say, why do I show RF by point X and not by point Y? Anyone?
So because there's no risk in it, right? So
Absolutely.
the variance for that would be 0.
Very good. So as Ali rightly said, I can show this via X here because it's a risk-free security, right? So that way the riskiness in my position is 0. So if my riskiness is 0, that means sigma is 0, and sigma is 0 on this cross section. So that's why I can show this RF here. I cannot show RF here. This will be incorrect because if I show RF somewhere other than this, that will mean that the risk-free security carries certain risk, which will be incorrect, because then we can't really call it as a risk-free security as such. So this is a brief behind CAL or CML. So those of you for whom portfolio management was not covered, I would suggest generally browse through things around Markowitz, Efficient Frontier, and things like CAL, CML, or even SML as well. Because these are things which may come handy later on, especially if you happen to join a portfolio management company or maybe any other fund houses. And also, I mean, these are not very difficult concepts to master. So maybe I can request you to go through them. If you run into any problems, let me know. Then we can discuss it further. Anything else which we can cover? Yeah, I think this is fine. So just some things which are related to risk. That's why we have covered it here. Also, I mean, there are a couple of performance metrics which we study as well. So a couple of ideas which we frequently use. So we can have a Sharpe ratio. Sharpe ratio can be one. Next would be an information ratio.
Taylor ratio, sir.
Sorry?
Taylor, sir. TYNO.
Correct. Trainer's measure. So was this covered as a part of your course as well, and performance measures for a portfolio?
I think the concepts were mentioned. Not
Okay.
sure if we even covered them extensively or not.
Okay.
I don't remember, to be honest.
Okay.
But we've heard the
Sir,
names.
Okay. So
yes, sir. They were mentioned so they were in syllabus for FE, not sure about IBEF.
okay.
And basically, sir, they are how much the expected value is away from, how much the real value is away from the expected value as a ratio of either the standard deviation or let's say the beta value. So for different values
Correct.
like that.
Correct. So, so again, for those of you who did not have this in your syllabus earlier, and these are what we call as couple of performance measures. So there are many other measures as well, but I have taken the ones which are comparatively simple to understand. So these are required because finally we need to know how exactly a portfolio has performed, or maybe how much is the compensation which you need to give to your portfolio manager. Now, that is something which you try to understand through these ratios. So many times as a part of your investment policy statement, these kind of ratios always feature. So this is going to help you determine what is the return which the portfolio manager has been able to generate for a certain unit of risk which they have taken. So standard formulas for this are expected return minus RF upon
Beta.
so upon the sigma.
Sigma, sorry, sir.
And whereas for trainer, it will be beta.
It
So
is
for
beta,
trainer,
yes.
it is So Trainer is more of a systematic risk measure because if you see, I've changed only the denominator here. For a Sharpe ratio, we take the total risk, which is sigma, which is a combination of systematic and non-systematic. Whereas for Trainer, we have a beta, which we call as a systematic risk measure. So a couple of measures which you will find as a part of the IPS or investment policy statement. So was the investor policy statement covered as well? Because that will help us relate with optimization ideas.
Sir, it is a statement which includes the client goals and the objectives and
Okay,
the how much risk they want to take and how much return they are expected, and
okay,
all the disclosure from the investment advisor also, like uh, suppose the number of different asset classes in which they want to invest.
okay.
So and
Correct,
from so this is only what I know.
correct. So Shubham, if I'm asked, are you a CFA candidate?
No, sir, I am a NISM candidate right now, sir. We
Okay,
are
okay.
we are
So,
actually preparing for NISM investment advisor level 1, sir.
okay, exactly. Then those things will be covered there as well because this is there as a part of the CFA curriculum also. But was the investor policy statement covered in your financial economics class or the IB class?
No, sir, no, sir.
Okay. So generally giving a slight digression from the capital thing, or maybe let's do this. Let's complete our capital bits and then we can come to portfolio optimization. So because this will take us in a separate direction altogether. So maybe let's hold on to this and probably after we complete the capital bits, we can talk a bit of portfolio optimization. So mainly applying the ideas of linear programming, etc., for optimizing a certain portfolio. So that is something which we can try through a simple hands-on as well. But request you to hold on to this for now. Maybe let's complete our discussion on the capital and liquidity bits, and then we can come back. So this was for fixed income. For equities as well, a certain similar structure will be followed. But for equities, the thing is, and the calculations are slightly different. The way in which GR and SR is calculated. Now, for equities, we have a standard weight which is given. So based on the ratings of your equities, or so when I say equities, rating of your issuers who are there for equities, your risk weights get decided. And based on the risk weights, you start to calculate what is the risk which is there in your equity position. Now, for banks, equities is not much of a problem, I would say. Now, yes, if it's a part of your position, then you will definitely have to take equities in your capital charge framework. But otherwise, for a bank's portfolio, they don't really have too much of equities which are there on your books. Now, as I mentioned the last time, your equities can either be traded equities. Again, those are very few in number because banks, even if they do invest in equities, they are either for taking advantage of IPO profits or booking IPO profits, or maybe certain liquid positions which they want to take. And otherwise, they have certain illiquid positions which are added because they are holding a certain equity through the CDR scheme, which we call as the corporate debt restructuring, which we discussed the last time. So for equities, these two are the general categories which you will find inside a bank's portfolio. Again, the quantum will be very, very small, so they don't contribute much to the capital charge. So there is a specific risk weight which is given based on the rating of that equity, and that helps us determine what is the riskiness of an equity position and how much it will contribute to capital charge. Again, a minuscule number as compared to other asset classes, so not something which the banks are very concerned about. Then for options, we use Greeks. So we have a couple of Greeks measure which gets used. So we use, if I recollect, we use Vega and Gamma as risk measures. So we haven't really discussed much on Greeks, but we'll talk a bit about Greeks in one of our subsequent sessions. We still have a few sessions to go. So let's see how much time we can allocate. But if not, I can maybe I give you a small document which explains Greeks and something which you can check out later on. But the idea is Greeks are measures which help us understand how much is the riskiness of a certain option position. So you have limits which have been set on Greeks, or maybe you have certain metrics which are tracked by risk managers and even traders to understand what is the riskiness of their options portfolio, and that is something which Greeks help us explain. And as a part of the regulatory guideline as well, we have Greeks which gets consumed in the calculation. So again, there are standard ways in which that gets used. So again, it is given specifically in the Basel guideline as to how to adopt these Greeks. But we use gamma and vega as two Greeks which are used in our calculations. Next are derivatives. So when I say derivatives, mainly your swaps portfolio. So you could either have IRS, CCS, or OIS as a part of your portfolio. So for calculating their riskiness, we have general risk, which gets calculated through and matched positions, etc. So the idea is what we do is we look at a derivative and we try to split it up into two legs. So let's say I have a swap transaction, then I'll have a fixed and a floating leg. So we divide that leg separately. So we divide that swap accordingly. So every swap trade, let's say I have a swap one, there will be leg one and leg two, which is the fixed rate and the floating rate leg. And for that, I do a separate calculation for my capital charge. Again, standard guidelines are defined based on the type of the swap, also the time to maturity for the swap, etc. And you calculate the risk for those positions as well. So imagine that you're looking at a swap as a combination of bonds. That is, I have a fixed rate bond and a floating rate bond, and then I put that in my portfolio for calculating the capital charge. That relates us to a certain idea which we call as a concept of disallowance. So there is a horizontal and a vertical disallowance. Slightly complex concepts to cover, but uh, so that is not something which we'll cover now. But those of you who are inclined, you can definitely check out again the Basel III circular, which explains horizontal and vertical disallowance. And the idea of such disallowance is to address various positions, because we know that the cash flows which are occurring for various products are occurring in different time buckets, and we need some way to combine the impact of these time buckets as well. So that's why the idea of disallowance gets used as well. And finally, you have to combine all of the assets together, because finally, when I say I'm calculating the capital charge for a bank, then that means that will be a combination of fixed income, equities, swaps, options, and forwards. So when I combine all of these together, I have a capital charge number which gets computed, and that is something which I use for my capital adequacy calculations. So this is also what we call as a capital charge framework. Again, something which will be programmed as a part of your enterprise risk software. So you'll have a batch process which will run on a daily basis to calculate these numbers for you, and you can consume them directly. And but many a times it can happen that if system goes wrong, you may require some way to maybe test if something has gone wrong, or maybe make an enhancement, because all of these are regulatory things, isn't it? So if a new regulation comes in, and if RBI says that we want you to change an XYZ point as a part of the circular, and accordingly your calculations have to change as well. So for that, if you are familiar with these guidelines, it is helpful. So if you do get a chance, I would say that generally browse through the Basel III circular, which will give you all the three pillars uh, of your capital adequacy. So one is talking about your sources of capital. Second is your actual calculation methodology, which is for credit, operational risk, as well as market risk. And third is the supervisory review, or what we also call as a related concept called as ICAP. So ICAP and SREP is something which is covered as a part of pillar 3. All of these are there as a part of your Basel III circular. Again, the July 2015 circular, which is being used. So if you do get a chance, generally browse through so that you have a better view of things. All right, so now we can switch back. So there's an idea which we call as behavioral models or behavioral analysis, which you require for liquidity risk. So the idea of behavioral analysis is to basically have an estimate as to what would be a certain quantity at a next time instance. So when I say next time instance, maybe at the next month end. So taking an example, let's say I talk of CASA, which is current account and saving accounts. So as a part of my liquidity framework, I may want to know how the CASA balances are behaving. So let's say I am a bank and I have been around for the last, let's say, 10 years. And imagine that I have CASA balances for every month end, which is available. So that way I'll have 120 points with me, isn't it? One for each month end. So let's say these are my average monthly balances which I have. So 1, 2 up till 120. And these are my average CASA numbers. So let's say this is entirely filled. Now this is simply historical data. I can just go to my database and draw these numbers. Now I may want to estimate what is the CASA balance on month end 121. So I'm standing on month end 120 and I'm trying to forecast what will be the CASA balance 1 month ahead. And this is something which may add value in my analysis. So can you, so now I have two questions. So firstly, why do I do this? Now, how does this help a bank? Why this estimation helps? And second is, can you think of an approach to do this? So would anyone like to attempt one or both of these questions?
Sir, can I try for the first one?
Yes, please.
So CASA is estimation is done to understand the liquidity the bank has to maintain on its hand in case the customer demand an immediate withdrawal. Like as the name suggests, current account and savings.
Uh,
Sorry, these are the most liquid deposits kept by the customers, and they are to be maintained readily. So in case of run on a banks, the bank has to maintain a certain cash in itself which cannot be invested. As a result, interest costs are very high for these deposits. And on joining to the adjoining to the second point, this, as I said, the interest costs are high because that money is blocked because you have to maintain it on hand.
Correct. Okay. Correct. So yes, so I mean the idea is CASA is an important concept and it's an important quantity for any bank. So if you see any bank's financial statements or financial reports, so now March end is coming. So starting first week of April, you'll see financial results of banks and other companies being declared. So especially for banks, you'll always see a CASA number which gets reported. So they always compare what the CASA was previous to the previous quarter or maybe to the previous year. Since this is the year and we can also compare it year over year. Now that gives an idea as to how attractive a bank is, or whether the or that's an idea of explaining whether the investors are trusting, or when I say investors, whether maybe people like you and me, our depositors, are trusting the bank with their money. So for a good quality bank, a healthy CASA balance is always expected. That is, their CASA balance has to increase over a period of time, because that means investors, or I would say depositors, to be more correct. Depositors trust the bank and they are willing to park their money with the bank, either in the form of a current account or maybe as a saving account. So when I say this thing, this may also cover your time deposits also. So all of these things basically explain your credibility for the bank. So that's why it becomes a very important number for a bank. And again, when we know when we talk of a bank, we know that the core bank's model is to borrow money from people and lend it to businesses. So people like you and me park our money with the banks, either in a saving account or a current account. And that money is something which the bank is going to advance as loans to entrepreneurs or companies or individuals who require those funds. That is the core business for the bank, borrowing money and lending it to the market. So this CASA balance number also determines how much is the capacity for a bank to lend outside. Because a growing CASA balance basically implies that the bank can pursue more business opportunities. So when I say more business opportunities, they can do more lending to borrowers outside, which basically helps their overall top line and bottom line growth to improve as well. So that's why a healthy CASA balance is immensely important. So again, what Mir also mentioned was correct. So I'm just adding on to his point. So that's why having an idea of CASA balances is important. Now, these CASA positions are something which also have an impact on your liquidity. So as he had mentioned as well. So a bank needs to have ample amount of liquid funds ready, because if depositors come asking for their money, bank simply cannot say no, because then investors lose trust and depositors say, I mean, our capital is at risk. So a bank will always want to maintain a certain portion of portfolio liquid, so that if depositors come asking for their money, bank should be able to make a repayment to them. So that's why liquidity risk, or what we call as asset liability management for a bank, that becomes important. And this kind of estimation is something which adds value, because then Your liquidity risk team knows that what are the potential CASA balances going ahead now based on the historical trends. And also, this information can be used by your traders in the front office because traders would also support your overall balance sheet management position. So, if they have an idea as to what is the estimated CASA balance next quarter or maybe at the next month in this case, they may want to position their trading decisions in such a way that they are trying to make the best use of the available information. And that's why having this information adds value. So this is part one. Now, if I have to have a model for estimating this, then which one would you suggest? Now, what is the kind of model which I should go in for? Anyone? So maybe something which might be covered in your analytics class, something which you could use here as well.
Sir, a model for what exactly do we want? To
So
predict the CASA deposits.
yes, correct. So if I want to predict this question mark, then what would be one of the approaches for that?
Sir, a time series analysis would work for this, I guess.
Okay, correct. So time series is one. Anything else? Something which may be comparatively simpler because time series requires some additional skill sets, but something which is easier than time series. Something which might be covered by your business analytics class, maybe as a part of your machine learning bits. So you could also have a regression.
Not sure, sir.
Okay. So regression also could be used. So when I say regression, not really a linear regression, but something more of a polynomial regression, I would say. Now, why I say polynomial? Because generally your CASA balances would maybe have a trend like this. Let's assume it's a healthy bank and it's growing. So let's say these are my CASA balances, and this is the time. So now if I decide to fit a straight line, it could be something like this. Now, which will not be able to capture the nature of data. However, if I can have something like a polynomial regression, we can actually correct these points in a much smoother way, and that will help me capture the trend in the data much better. So maybe a polynomial regression could be done as well. So was polynomial regression covered as a part of your business analytics class?
No, sir. We only did linear.
Okay, okay. So the idea of polynomial regression is to capture any kind of non-linearity, especially things like CASA balance, because whereby your linear model may not be good enough because it does I mean, not the fault of a linear model, I would say, because it doesn't understand curvature. Now here you have a curvature, so you need something which is better. So you must
So,
have studied. Yeah,
uh,
sorry.
I think in business analytics, sir had just mentioned that in polynomial it works the same way. You just take a single variable like x and you take it to multiple powers and you just try finding the different betas and it works in the exact same fashion as the previous ones.
Correct, correct. So something similar, yes. So just adding to his point. So yes, mentioned it correctly. So for a linear regression, we have something like this. Let's say ax plus b, or maybe ax plus bx plus c, something like this. Now this is a linear or order one, also called as a linear regression. Now let's say I have order two. So this could become something like ax square plus bx plus c. Now again, we are just sticking to univariate quantities, so we are just having x. Otherwise, we can have other items as well. Now here we don't really require them because we are working only on CASA balance. But if you have multiple quantities, that is, let's say you have CASA, maybe credit card receivables, and you're trying to build some complex model whereby you have multiple inputs, then that time maybe a multivariate thing would be required. So you'd have maybe ax square, ay square, or maybe by square and something like that. So let's not worry about that for now. But this is the idea of a higher order regression. So something like a quadratic, or maybe you could have a cubic as well. So ax cube plus bx square plus so on. So all of these are what you call as a type of a polynomial regression. So within Python, you have a polynomial features through which you can decide the order for a certain polynomial and you can use it in your calculations. So again, as a part of your machine learning class, was the idea of model overfitting covered? And have we
Yes,
discussed
sir.
that as well? So have we discussed that in any of our previous classes?
So not with you, sir,
Yes, sir,
but
we did.
Okay, okay. All right. Correct. So basically, if you're using polynomial regression, be careful as to the idea, or be careful that you don't overfit the model to data, because that basically implies that your model understands the current data set well, but may not be able to understand newer data points which get fed in. So that we always try to remain on the lower order of the polynomials. So generally for finance, we do not breach order 3. So order 3 is good enough for any kind of or most of the modeling which happens in finance. Maybe for other type of industries, maybe for image processing, etc., or maybe if you're scanning maybe X-rays or maybe medical charts, etc., you may require some higher order polynomials. But for finance, generally, order 2 or 3 is decent enough for any kind of modeling exercises. So generally, polynomial regression is something which we tend to use. And again, we just try to optimize the values for parameters. So here, A, B, and C. These are what you call as the model coefficients. And it's the model coefficients which you try to optimize. So given a certain set of data, you try to tune the model to the data so that you have best fit value for A, B, and C. And that's what we call as a model coefficient, something which we use in our calculation. So whenever you say you're fitting your model to the data, that basically implies that you're trying to understand what's the best fit value for A, B, and C. And of course, if you have more variables, more number of variables as well. So this was with regression. Yes, you can also do a time series analysis. So maybe ideas like ARIMA, etc., were they covered as a part of your other subjects? Auto-regressive
Rima, yes, sir.
integrated moving average. So again, a very popular model which gets used
But I'm
in
not sure if it was covered for both classes. For FE, it was covered.
Okay, okay. So did you guys also build a ARIMA model?
Yes, sir.
Okay. So I think you guys might have used R, is it, or Python?
Yes, sir. We used R.
Okay, okay. So no problem. I mean, any tool should be fine. But good. So, but for others who have not done ARIMA models, again, these are some things which are powerful and something which are used by the industry quite frequently. And again, time series analysis is a very valuable skill set to have, because there are not too many resources in the market who understand time series really well. So if you can understand time series well and apply it on projects, it is something which will add a significant amount of value. So I would suggest for those who have not done time series previously, again, it's not a very difficult skill to pick up. I would say that generally browse through ideas, and that way you'll get to explore things like ARIMA, etc. Now with scripting, there are ways in which you can automate things as well. So there is something which we call as a auto ARIMA in Python. I'm not sure if there is that exists in R. I think there may be some similar functionality. So through auto ARIMA, we try to have the optimal values for parameters P, D, and Q. So those of you who have studied ARIMA will know that P, D, and Q parameters are something which we try to optimize. So as a part of auto ARIMA, Python itself will try and optimize these values. You don't have to do the charting and plotting yourself, because otherwise uh, things like testing for ACF, PACF plots, also maybe trying for stationarity, etc. All of these things are something which we have to do manually. Now again, personally, if you ask me, that is something which I prefer. So when I have to do time series modeling, I always do things manually. I don't use auto ARIMA because honestly, I don't trust Python that much, and I don't want to leave everything in the hands of the machine to do it. But maybe given a certain data set, you can optimize these values of P, D, and Q, so you can use your judgment as well, and you don't have to depend on the machine. And maybe as a part of your basic checking, what you can do is you can have a parallel auto ARIMA model as well. So firstly, you have your ARIMA structure, you decide your P, D, Q terms, and then maybe have a parallel model which does auto ARIMA, and you can compare your results versus the machine. But again, that depends on the time which you have for a certain project. So let's say you have to maybe complete a ARIMA model in like next 20 minutes or 25 minutes. Then working on PD and Q doesn't make sense because you don't have that much time. Then maybe just use auto ARIMA and publish your report. So that way, I think depending on your project requirements, you can decide one approach over the other. Of course, now every approach will have its plus and minuses. So I think based on the scenario which you're in, you'll have to pick one technique. So in R as well, did you guys manually calculate PD and Q, or did you use an automatic function to calculate PD and Q?
So we did both.
Okay, okay, all right. So do the numbers of PD and Q match, or there's a slight difference between the auto and the
So
manual?
usually they match, but in one case you are actually able to beat Autorima because, like you said, you cannot trust the machine entirely, right?
Correct, correct, true. But good. So good. I mean, just like R, even Python has something like auto anima. You can check that out subsequently. So yes, these two techniques.
Sir, I have a question.
Yes.
Sir, in this regression, what exactly is our X?
So X will be
Like,
my data points which are coming in.
but sir, to run a regression, you need these data points to change frequently enough, right? So if you're doing
Uh,
a daily or a weekly report, then how does a regression make sense?
so, so yes, I mean that can be a problem with data. So generally, what happens is banks have a long data history with them, because most banks which we see have been around for last maybe 25 or 50 years. So maybe what a bank could do is to increase the number of data points. They could possibly have maybe data fetched every fortnightly, or maybe if you have a good infrastructure, you can have a daily closing CASA as well.
Sir,
But
I
yeah.
think he's asking other than CASA itself,
Mhm.
because if you're studying only about the previous CASA, then that's time series. But is there any other X that we're considering, any other variable that we're considering?
For this example, not really, but you can definitely have that. So that way you can have that additional variable which can be used in the modeling as well. So that is something which you can definitely do. But for
So, sir,
plain
that
CASA,
exactly is my question.
correct.
So that exactly is my question. So suppose you were to also factor in interest rates or something.
Mhm.
Now, this is not something that's going to change every week, right? Probably every quarter it's going to change.
Correct.
So, regression, we can always run the regression, but would it be making any sense? That's my question.
So I would say that, and for points like interest rates, or maybe for even inflation, it's a problem definitely, because that way, I mean, the frequency of that change is very, very slow, and the quantum also may not be very large. So generally, when we do such kind of behavioral modeling for especially CASA or probably credit card receivables, as I mentioned, we generally try to stick to a univariate time series. We don't try to use something else along with this. Now, maybe if you're working on some other model, you may want to combine that with interest rate data, or even inflation-wise data. But again, the frequency of data is something which can definitely pose a problem, I would say. Uh, so that is something which, I mean, a bank will have to live with, because CPI numbers, or I mean other numbers, is something which is beyond the bank's control. Now that will be available only on a lagged fashion every month end. But maybe those things which are in control of your, or maybe those data points which are in control of the bank, especially things like CASA. So rather than having month-end balances, try to increase the data points so your model is able to understand the data more. So possibly rather than having month-end balances, maybe have balances every 10 days, or maybe every fortnightly, and then maybe have a longer series of data points. But I get your point. It's always good to have more data points to consume rather than lesser. So wherever possible, banks will always try to have those things in place. But again, the thing is, reconciliation of these numbers can be a challenge, especially from an operational perspective, because many times what happens is, for getting to this CASA balance, what ALM teams do is, especially those of them who don't have an automated system, they may have to get data from multiple places before they report their CASA balance for a month end. Now, they may be doing a specific activity which, so let's say, calculating your actual CASA balance, something which requires data from 10 sources. Now, maybe it could be the case that during the month, they are using those, or majority of the points, which gives them an idea of CASA, but maybe for their month-end reporting, they require a couple of more points. So 10 plus maybe a 5 points are required for month-end, and that makes the CASA number more comprehensive. So that's why I said month end, because why I said month end is, for your regulatory reporting, month end also happens to be a key data, time point at which you report numbers. So yes, other days during the month, you will use the first 10 data points, which will give you an idea of CASA. But maybe to have some additional data, which will give further explanatory power, you try to stick to these month end numbers. So that's why I say that generally banks would want to use a month-end balance or maybe an average balance, but based on that month-end data. However, if the bank has the required kind of operational infrastructure so that they can use the same methodology applied for month-end every fortnight or every 10 days, then they can use those CASA numbers as well. So I would say more from a system efficiency perspective, this month-end thing is something which banks find comfortable because anyways they're doing these calculations for reporting purposes. So might as well use the numbers directly rather than making your system do a separate set of calculations, which may have an impact on other systems because your system infrastructure will get consumed there.
Okay, sure, sir. Thank you so much.
So, like CASA, credit card receivables or what we call as CC is also something which could be modeled as well. Now, here maybe you may have to track seasonality also because we generally see that credit card receivables, etc., generally behave in such a way that they have a seasonal pattern. So, generally during a festive season, you will find more credit card spending. Whereas if you compare that with, let's say, the exam period. So in India, we have the exam period of March, April. So at that time, generally, families don't spend that much because they don't have time to step out because their kids may be studying in school. So that time, maybe credit card spending could drop. So again, these are the kind of seasonality patterns, etc., which a bank would always want to factor in because that basically helps them manage their overall liquidity position in a much better manner. Okay. Duration gap analysis is something which we have covered here as well. So what's the time? Are we at 10:20? Okay. Okay, so we are at 10:25. So can we take a quick break for 5 minutes and come back by 10:30 and resume?
Yes, sir, works.
Yeah.
Yes, so that will work.
Okay. Hi guys, can we begin? Is everyone back?
Yes, sir, we're back.
Okay. So a few terminologies which you may have already come across in the past, but generally going through them because these are a few things which you popularly see in the banking business. So CRR or cash reserve ratio. So CRR, SLR, repo, etc. All of these are also what you call as policy rates. So something which gets included as a part of your MPC policy statements also. So after every monetary policy committee meeting, you have a minutes of the meeting which comes in, and those talk about these policy rates. So CRR is what you call as the cash reserve ratio. SLR is the statutory liquidity ratio, etc. So what's the main difference between CRR and SLR?
Sir, CRR is to curb the multiplier effect. SLR is to maintain the bank's liquidity.
Okay, and but something from so maybe from interest perspective for a bank. So how do
So
these?
CRR would not be earning interest for the bank.
Correct.
SLR would be.
Very good. Correct. So CRR doesn't really earn any interest for the bank because that is the fund which is parked with the RBI, and RBI doesn't pay any interest on those funds. But for SLR, yes, because SLR happens through investments in approved government securities. So those government securities pay a certain periodic coupon. So that way, whenever a bank is investing money in SLR, yes, I mean there will be a certain coupon payment which gets paid out as well. So that way, it will earn interest for the bank. Then you have a repo rate, which you call as a repurchase agreement. So repos can happen between banks as well as it can happen between the bank and the RBI as well. So repo or repurchase. Then you have LCR or what you call as the liquidity coverage ratio. So again, a metric which is calculated on a daily basis by the bank and which has to be reported to the RBI as well. So every day at the end of the day, once your positions are available, this LCR computation has to be completed. So the idea of LCR is to ensure that the bank has ample amount of liquid funds so that it can meet all of its commitments which are due in the next 30 calendar days. So this is the idea behind LCR. So the idea is to ensure short-term liquidity for the bank. So the standard ratio for LCR is HQLA, which you call as a high quality liquid assets upon estimated cash outflows. So again, the exact way in which this formulation happens is given in the LCR guideline by the RBI. So those specifics you can check out later, but generally giving an idea of what LCR is. Now, firstly, this ratio ensures that the bank has adequate amount of unencumbered assets. So when I say unencumbered assets, what do you feel? And what could be the meaning of this term? So unencumbered basically implies that these are unpledged securities. Unpledged or those securities which are not used as collateral anywhere. So banks frequently use certain portion of their portfolio as a part of collateral, or they pledge their securities for a certain transaction before they go ahead. So those are what you call as encumbered securities. But for your LCR calculation, you require those securities which are non-pledged or those which do not have anything linked to a certain collateral position. That is, they should be free securities for a bank to trade at any point in time. So that is what you call as an unencumbered security. So unencumbered and liquid securities are something which are required as a part of the LCR calculation. Again, the goal is to ensure that the short-term liquidity of the bank is maintained. So 30 calendar days is something which the regulator says. HQLA will be a combination of three types of assets: level 1, L1, L2A, and L2B. So L1 is mainly government securities. So this is also what you call as the treasury securities. L2A securities which are issued by government-backed agencies. So maybe like SIDBI, NABARD, etc. Level 2B could be corporate debt, common stock. So corporate debt can be maybe a bond which is issued by a certain non-bank. Sorry, not a non-bank, but non-government, I would say. So maybe a corporate security, bank security, NBFC, etc., or even your common equity. Now, the details of this you'll get in the LCR guideline. We'll not get into the details because that itself will take a couple of 2 or 3 sessions because it's a large guideline that way. It's not very difficult, I would say, because the thing is there are no gray areas as such here. Now, what has to be done has specifically been given by the Reserve Bank. So that way banks have to simply stick to that guideline, but they have to ensure that all of these things are captured as a part of their framework, because these are computed and reported on a daily basis. So every day, these numbers are computed. Again, you'll have a batch process for this, which will run on a daily basis. So all of the system logic is already there in the system. So those of you who are joining banks or maybe who are reviewing models for banks, these models will already be there in place. What all you're doing is you're simply reviewing those models or maybe enhancing them as required. As I mentioned, if RBI says that we want you to change one portion of the guideline, so whenever that portion changes, banks are also required to make a small change in the methodology. So at that time, if you're familiar with the idea of LCR and maybe generally have an idea as to how a bank is calculating LCR, etc., that is something which will help you. So I would say when you do get a chance, generally browse through the LCR guideline. But this is the main idea behind LCR, ensuring that your short-term liquidity remains intact. Next is what you call as NSFR, or net stable funding ratio. Now, this is more from a longer term perspective. Now, we have already addressed the short term through LCR. Now, something which is of a longer term is what we try to understand through NSFR. Again, more of a regulatory requirement and something which needs to be calculated on a daily basis. Now, this is a ratio of your stable funding available upon the stable funding which is required. Because finally, why we talk of funding? Because we are talking again from a core bank's business. It's borrowing and lending of funds. So that way, the sources of funds as well as the places whereby those funds are going to be deployed, a proper track of that is required so that the overall balance sheet position of the bank gets maintained. Now, the main reason behind NSFR is to enable a bank to diversify its funding sources so that they can reduce their dependency on any specific wholesale deposits. Now, for any bank, a wholesale deposit is something which is a key source of funding. So, in a bank's book, you'll always find a separate category which talks about your wholesale depositors. So, wholesale depositors have a quantum of, let's say, something which is more than 5 crores. So, that is something which you can classify maybe as a wholesale deposit, because these are large deposits which are placed with the bank. So whenever a wholesale depositor exits, or maybe if a couple of wholesale depositors exit, that becomes a kind of a news for the bank. Because then that's a point of concern. Because if your wholesale depositors start leaving you, that means a subsequent amount of funds which are available with the bank are diminishing. Because when a wholesale depositor says, I want to withdraw my funds from your bank, that means that kind of funding has vanished from the bank's books. So that has an impact on the overall lending operations as well. So generally, you will also observe the impact of this on equity prices. So whenever there are analysts or news reports which talk about wholesale depositors withdrawing their money from a certain bank, that bank stock is definitely going to take a hammering, because then the market knows that something is wrong with the bank. That's why depositors are not trusting their money with the bank. And that is something which gets factored in a equity price as well. So generally, you will observe that such a movement or such a drop in wholesale deposits, and if that makes news, then that has a detrimental effect on the overall stock price for a certain bank. So I think recently one of the private sector banks had seen a drop, or maybe a couple of large wholesale depositors leaving. I don't recollect the exact name, but I had read a news report, I think last year. But these kind of things keep on happening. So banks always try their best to ensure that their funding sources are diversified. That is, they should not have a dependency on maybe one or two wholesale deposits only, because if that happens, and if those depositors say that we are withdrawing funds, then that can put a bank's capital under pressure. So that is something which every bank would want to avoid. So again, they would want to diversify their funding sources. Now, available stable funding includes proportion funds which are expected to be reliable over a certain period of time. And when I say certain period, it's a longer period, which is more of maybe a 1 year time period, because short term, as I said, is addressed, but long term is something which we try to look at. And also things like liquidity and maturity characteristics are something which need to be tallied, because when we talk from a maturity perspective, always try to think of it from your overall balance sheet management perspective. So you can relate these ideas with the idea of duration gap. So duration gap was something which we discussed, I think, in the previous class, where we spoke of duration of assets minus duration of liabilities. Ideally, we would want this duration to be zero. Again, this will be linked to the maturity of your investments and or maybe maturity on both sides of your balance sheet, assets as well as liability. So trying to maintain these things also is in line with this overall NSFR framework. Now, as I think I had mentioned the last time, there is an ILAP guideline. We don't really use that much in India, but in European countries, they use ILAP as well. So internal liquidity adequacy assessment program. So things like LCR, NSFR, behavioral modeling, balance sheet risk management, etc., everything gets covered as a part of the ILAP framework. So those of you who are planning to maybe join a bank abroad, this is something which you can definitely check out. Or maybe if you're planning to join a consulting firm abroad, this is something which is required these days. Now, ICAP and ILAP, both of these are valuable skill sets to have. So again, these are more comprehensive framework because bits and pieces banks are already doing anyway. So things like capital charge calculation, CVA, off balance sheet management, or maybe things like LCR, NSFR. So bits and pieces banks are already doing, even stress testing. Now, the idea of these larger frameworks is to combine all of these together so that the bank has a more comprehensive picture of the way in which its overall capital is being managed. So that's why ICAP and ILAP is something which will add value. So ICAP is something which you will find as a part of your supervisory review process, SREP plus ICAP. So this is there in your new Basel III guidelines, and this will be under Pillar 3. ILAP, I don't think this terminology is used in the Basel, maybe in the RBI's guideline, but again, there are pointers which take you to ILAP. So you have guidelines on LCR, NSFR, stress testing, etc., which helps you relate with ILAP. So maybe if you combine those things together, you have something which is analogous to ILAP, which has been issued by the European regulator. But again, an interesting area to definitely explore. So what I would suggest is you can definitely check that out. And there's something called as a MSF or marginal standing facility. Now, this is something which will allow banks to borrow from the Reserve Bank on an overnight basis. So many times bank may require funds, and for that they may want to approach the RBI because they may have a certain balance sheet gap which they are trying to address. So that is something which they can transact with the RBI on. Now, again, before a bank can tap the MSF facility, it's required that the bank has to maintain its SLR requirement at all times. Now, that has to be maintained. Without that, bank cannot use the MSF facility. So that is basically to deter banks from using the MSF route to meet their SLR requirements. That is something which will not be acceptable. But once their SLR requirement is met, banks can definitely approach the RBI in case they require some help on the funding side, and they can tap it through the MSF route. Now, there's a certain top limit which has been placed, which is 1% of NDTL. So NDTL is net demand and time liabilities for the bank. So MSF is limited up to 1% of NDTL on an overnight basis. And generally, MSF rate is higher than repo rate. So this is something which RBI will not really appreciate that much. So RBI would say that we want you to manage your funding sources well. So that's why they set the MSF rate, which is higher than the repo rate, which will basically deter banks from approaching the RBI for such a funding facility. But the idea is this avenue is there. So in case a bank runs into problems and if requires some help, this kind of a facility can be availed for. Banks by themselves will always try to maintain their balance sheet position as much as possible. But wherever help is required, they can go in for such additional funding as well. So this was a brief behind capital charge, or maybe the idea behind capital models. And these were more from your regulatory perspective. Again, something which is very, very useful, I would say. So something which I request you guys to check out, because if you have an familiarity with this, and then that will give you more confidence if you have to use this once you join your respective jobs. So especially those of you who are joining consulting firms, you may be expected to work on projects around ICAP or ILAP. So at that time, maybe having familiarity with these guidelines is useful. If you are a part of a bank, then naturally these things are something which will be there in your system. So you may have to either do an independent review as a part of for your bank, or maybe develop something new which may come up as a part of ICAP or ILAP as well.
Excuse me, sir.
Yes.
Sir, how do banks decide whether to borrow from RBI through a repo transaction or through MSF?
So basically they'll try to do it through a repo because MSF is generally more expensive as compared to repo. But there may be a scenario whereby a bank may feel that maybe an MSF facility is something which they want to go in for. But I would say that uh, if you talk from a bank's funding perspective, it will be firstly, so they will try to avoid MSF as far as possible because it's expensive. So as far as possible, try to do it uh, through the interbank market. So that can be their first choice because banks frequently transact with each other on an overnight basis. So interbank market could be the first choice. The next choice could be the regulator or RBI. So banks do transact with RBI, but again, that would be like a second choice, as I said. So I would say that it would be more from the overall rate at which a bank can borrow and also the availability of funding, because it may so happen that if a bank is not really in a very strong position, then other banks may not be very forthcoming uh, for lending to them, or they may charge a higher rate. So at that time, maybe the bank might want to approach the regulator or even use the MSF facility. So I think based on the overall riskiness and the cost of funding, a bank might have to take a call which could be the best way of procuring funding.
All right, sir.
So we are at 10:40. We have time, so maybe we can start with some discussion on value at risk. We just open up a new presentation. So do we do value at risk now because it's 10:45? I don't think we'll be able to complete that in half an hour. But maybe we can do something else in place of that. So we can do a bit of interest rate options, or maybe, yeah, I think interest rate option should be fine. So let me just open up a new presentation. So talking a bit of interest rate options, again, interesting products which are used by market participants. So we'll try and understand what these products are and a simple model which gets used for these as well. So concept of an interest rate derivative. So when you say an interest rate or a IR derivative, that basically implies that you have a certain interest rate as the underlying, because for a derivative you require some underlying. So for an interest rate derivative or IR derivative, your interest rate happens to be a quantity which is the underlying. So you can take any floating rate or any benchmark rate as an underlying rate for interest rate derivatives, and you can use it. So up till now it was LIBOR. Now going ahead, that is set to change. So you may have newer benchmarks which get used as the underlying rates. But otherwise, historically, LIBOR has been the leader when it comes to interest rate derivatives, and that was a popular benchmark which was used by market participants. Now, generally, when we talk from a modeling perspective, or even from a pricing perspective, generally interest rate products are slightly difficult to model because we have seen a simple model for equity, which was the GBM. Now, from a equity or FX perspective, this is the only model which is available. This is it. The GBM is all that we use. However, for interest rates, that's not the case. For interest rates, you have other models as well. So you have multiple scientists who have developed new models, and that is something which the market consumes. So that way, for interest rates, you have multiple other models which are available. And and generally, whenever we talk from modeling perspective, we keep equity and FX together, maybe even commodities, and we keep interest rates separate. That is because interest rate is slightly more complex when it comes to the modeling exercise. So a few points as to why interest rate modeling gets challenging. Firstly, the number of models are more. So you need to understand the nitty-gritties of those models before you can start using them. But maybe a couple of steps prior to that. Firstly, for interest rates, you need an idea of zero rates or spot rates as we call it. Now, without having the idea of spot rates, it's impossible for anyone to work on an interest rate model, because as we know that spot rates are the building block on which we do many other things. So, given a certain yield curve, we try to construct a spot rate curve and then the related ideas like forward rates, etc. So, firstly, having a bootstrapping calculator which will calculate zero rates for you, that is something which we require for interest rates. Now, that is something which doesn't exist for equities or FX, isn't it? So, that way, this problem doesn't exist for equity or FX. So, that way, modeling becomes easy there. But for IR, no. I mean, this bootstrapper has to be there. That is, you need some way to figure out zero rates. Next is you need to have that extended implied forward calculator as well, because we know that we have multiple time periods in the future which we are interested in. And at that point in time, implied forwards are something which are required. So that way, again, one more complication which comes in the modeling exercise. After spot rates, you need something on implied forwards as well. Also, along with that, you need to keep track of volatilities which you observe in forward rates. Now, I am stressing more on the forward rates part here because most of the floating rate varieties which you have as a part of your portfolio will have a more sensitivity towards the forward rate curve. So, yes, spot rates are important. But however, from the overall impact on the price of a certain floating rate product, forward rates are something which are more significant. The reason behind that is whenever I have a forward rate or whenever I have a certain product which is dependent on forward rates, let's say a floating coupon bond, then that means I have coupons which are appearing at different points in time in the future. Now, for calculating those floating coupons at different times in the future, I need the idea of forward rates. So as the forward rates change, I'll have an impact on the coupon values, and that impact is going to have an impact on the overall price of that security. So that's why whenever you talk from a risk management perspective, or when you talk to a derivatives trader, or even maybe a fixed income trader, they're always concerned about the way in which your forward term structure is behaving, because they know that forward rates are going to have a lot of impact on their positions. Especially derivative traders will be very, very careful about these things. So as a part of their ready calculator, they'll always have these forward rates which keep on populating, because based on that, they know how exactly the rates are going to move, or maybe have a decent estimation as to how rates are going to behave at different points of time in the future. And based on that, they may want to make a certain decision. So I would say because of these three or four points, the complication of interest rate modeling becomes more as compared to equities or FX. But again, IR modeling is something which is interesting as well. So something which I would definitely recommend you guys to explore. Now, we'll not be able to cover interest rate modeling as a part of our course, because IR modeling by itself is going to take at least 5 or 6 sessions, because it's a very large area to cover. But those of you who are interested in the IR modeling side, you can reach out to me and I can give you a few resources which you can definitely check out. Now, again, interest rates is a very good area whereby you can apply numerical techniques as well. So we have done something via simulation as well, and we have discussed the binomial tree. We did not do finite differencing, but that's fine. Through simulation or even through trees, you can easily do an interest rate model. So that is something which you can definitely try out yourself. Now, there are certain interest rate models which can be done through a binomial tree as well. So something which we call as so there are multiple models, but one which can work through binomial or through a lattice structure is a Black-Dermond toy model. So something which you can check out later on. If you want to model this thing, it is possible to do with a binomial tree. Otherwise, for other models, maybe you may have to go in for some kind of a simulation exercise, or maybe even an advanced finite difference scheme. But binomial, naturally, it's comparatively easier to program as well. So maybe this is something which you could check out. But that way, you'll find a considerable application of numerical techniques inside interest rate models. And again, as a career path as well, interest rate modeling is something which is like an evergreen path, because as long as banks and lending institutions exist, the relevance of interest rate will always be there, because that decides your cost of funding, right? So even for companies, they also want to know how exactly the rates are going to behave in the near future, or maybe in the far future as well. So at that time, having a good quality interest rate model will give you a decent enough estimation. Now I say it's an estimation because you're trying to uh, estimate or trying to have the best view as to how rates are going to move in the future. Finally, what rates are going to realize, you don't know, because that you know only when you reach that point in time in the future. But until then, it's always good to know how exactly rates will behave. Maybe one of the applications of this can be deciding the time at which a company wants to go in for funding. So again, this is something which you can relate from your cost of capital perspective. So based on the way in which your interest rates are going to behave in the future, a company might want to decide on the timing, or if they want to time its funding activity accordingly, so that it can lock in the lowest possible rate of funding, and that way their cost of funds comes down. So that can be one application. Next can be, maybe a derivatives team might want to structure a new product. So maybe your front office, or what you call as the GMG, they may want to structure a product based on this, based on the expectations of rates, because structuring is a very important area from the front office perspective. Because when you say structuring of a derivative, that means they are trying to create a new product which they can sell to clients or maybe to their counterparties, and that is something which will sit on your trading position or sit on your trading book. So that way, structuring is something which will also find a value addition if you have a good quality IR model. But scripting tools are something which are very useful when you talk from rates modeling perspective. So I would suggest that you guys already know R. So I'm not sure how many libraries in R are there for modeling, but in Python you have ample amount of libraries which can support on rates modeling. So something which I would definitely recommend try out. Try the simplest one. Try the binomial one first. Maybe you can apply a binomial model for option pricing. So once you have an idea of that, you can try and extend that to a BDT or maybe something of rates modeling side. But something worth exploring. Again, don't try to tackle everything in one go. It's impossible, because interest rate modeling is a large area. So maybe even if you get your basics clear by the time you graduate in June, July, it will be good enough. Later on, once you join a respective bank or a financial institution, you'll get to learn more. So I would say look at it that way. Then a few widely used benchmarks, LIBOR or any other floating rate benchmark, let's say MIFOR or MIBOR as well. Then models used are, so Black's model. So in the industry, Black's model is something which gets used for interstate derivatives or maybe interstate options, etc. Binomial model, this is something which we'll study just to understand the overall structure of the derivative. But in the industry, we do not use the binomial model for pricing an interstate option. So in practical circumstance, you'll never observe a binomial model being used. But from a theoretical perspective, it's always good to understand it through the binomial variety and then relate it with the Black's model. Again, based on the same premise, that it's always good to learn things in the discrete time space first before you move on to continuous time. And binomial model is a discrete framework, whereas Black's model is a continuous time framework. So this is something which you can show via a diagram, which makes it more appealing. So we'll also follow the same thing. When we understand the approach for pricing of, let's say, an interstate option, we'll try to do it through a simple binomial technique. Once this is clear, then you have to simply extend that to Black's model. Now, unfortunately, Black's model is something which we cannot show with a diagram because it's a continuous time system. But once the binomial idea is clear, extending that to Blacks is easy. Something similar to what we have done for our plain European options as well, when we studied binomial and Black-Scholes-Merton. Now, a few popular interstate derivatives, you have IRS and CCS. So did you guys have a separate review of IRS and CCS in your previous subjects? So were these products introduced as well? And maybe have you done pricing of these products also? Interest rate or currency swaps?
No, sir.
No, sir.
Okay. So this was covered so this was not covered for both of the classes, is it? FE and IB? Okay. Okay. All right. So again, now I'm not sure if we'll get that much time to cover this thing because I thought this might be covered as a part of your other subjects, maybe around. Fine, but let's see. But here we are going to focus our discussion on the last four varieties: caps, flows, collars. So again, if I have to look at these four items, I can combine the first three together because these are very similar in nature. Whereas swaptions is slightly different. So the structure of these three items is comparatively similar to each other. Swaptions is slightly different. So once we study caps, understanding flows is easy. And once we know caps and flows, it's just a one step ahead to understand collars. But again, popular products which are used by banks. Now, even in India, you have banks which have caps and floors as a part of their portfolio. So this is something, or this is one of those approved products which is there for banks' consumption. So you'll find many banks which hold such position. They could either be in the bank's book or the domestic book and in the gift city book. So are you guys familiar with the gift city operations for a bank? So was that covered as a part of your financial institution subject? So,
No, sir.
okay. So every bank in India, there are two sections to it. One is domestic and other is gift city. So domestic is all of your domestic operations. So something which you do within India's jurisdiction. This is what you call as maybe a domestic transaction. Now, when I say this thing, you can definitely transact with foreign banks here as well. That's possible. So you may have a transaction with JP Morgan, Singapore as well. So again, that can be classified as a domestic one. But there is a gift city book which is separate. So when you say a gift city book, now this is a part of the gift city which has been built in Gujarat. And the idea is to have more integration with the global markets. So in the gift city book, or the main differential between gift and domestic is in the gift city book, your local currency is US dollars. It's not INR anymore. So USD happens to be your local currency for anything which you do in the gift city office. And this helps you transact with your foreign counterparties in a much better manner. So the RBI and the government's idea behind setting up the gift city branch was to enable banks to have more amount of international transactions. And for that, they have started with this gift city. And most, or I would say rather every bank who has a domestic operation in India and who has a banking license has a gift city branch as well. Now, gift city branches are there to transact with their international counterparties, and generally, I think gift city is something which I had a couple of friends who used to work on the gift city desk. So they used to generally come in the evenings because so by the time we left around 5:36 when I was doing full time in the bank, those guys used to come in around 6:30 and they used to wait overnight because the thing is they had to transact with foreign counterparties. So maybe someone in London or maybe someone in New York. So because your gift city trades are mainly driven through your foreign transactions. So generally you'll find gift city traders to sit late night and work. But finally, whenever you look from an overall bank's perspective, it is going to be a combination, domestic plus gift. So every transaction which happens in both of these books have to be collated and reported at a bank-wide number. So you may be having USD as the local currency for gift, but finally everything gets converted into INR before it gets reported at the bank-wide level. Because finally, since the bank itself is, let's say, an Indian bank, so let's say I'm talking of ICICI Bank, then ICICI numbers have to be in INR because it's an Indian entity. So although your local currency is USD in the gift city office, you have to finally convert your numbers into INR before you report it at a bank-wide level. But the idea behind gift city is it allows banks to transact in structured products as well. So things like caps, floors, or swaptions, etc., are already a part of gift city branches. But now swaptions and other structured varieties like barrier options, etc., are also becoming a feature of domestic books also. So based on the new RBI guideline which had come in a few months back, banks have started transacting first order exotic options as a part of their portfolio. I think I had mentioned this earlier as well. So now swaptions or barrier options, etc., are forming a part of the domestic book now. They were already a part of the gift city anyway. but now even domestic branches can do that. And it's always good that you have such kind of reforms which come in, because reforms come in whenever there is a market demand, and when the regulator is comfortable that and it feels that the market is mature enough to introduce these things, then the regulator gives the approval. So that way, RBI is a very robust and a strong regulator. It has a very strong hold on the overall banking framework, which I would say is very good, because it has multiple advantages to that as well. And one of the main advantages we saw was in 2008. So when the entire world had taken a hit, India was comparatively insulated. And it's all thanks to RBI, I would say, at that time, because RBI had kept such a strong grip on the banking industry that it did not allow the shocks to come to the Indian shores. So yes, there was some shocks. That is always going to be there. But compared to what happened in these open markets, like maybe Europe or America, that is something which did not happen in India, because Indian banks simply did not have those many positions. So that way we were protected. So that way, RBI or regulatory organizations always come up with these reforms which are there to support the market. And that's exactly in line with what the new RBI guideline says about allowing banks to permit first order exotic derivatives trading. But this is the idea behind domestic and gift city. And you'll find these products to be already a part of gift city, but gradually they have started percolating to the domestic book as well. So any questions on this time? Okay. All right. So before we go on to other things, I think it's 11:05. So we can stop at this point, because these are the things which I would like to do in continuation. So talking of binomial and Black's model and relating it to caps, floors, the applications, and then coming on to swaptions. So that is something which ideally I would want to do it together. So that is something which we'll do in our class on Wednesday. So on Wednesday, we'll try and complete this, and then maybe we could begin our discussion on value at risk. So VAR is something which we have to cover as well. So we'll try and cover the bit on VAR, and we'll try and do some hands-on as well. If time permits, I'd like to do a VAR model with you guys. So that is something which we'll target to do maybe this week, because I think we are on the 16th class today. So we still have 4 more sessions to go. So we'll try and combine some hands-on as well, because VAR model is something which you will frequently use in the industry as well. So if you're familiar with that, and if we do it via one approach, it will give you more confidence to work on that model later on. So we'll try to do that maybe on Saturday, and we can do that through Python as well.
Excuse me, sir.
Yes.
So 2 things. One, you said something 4 sessions of what, sir? Will that complete the course or?
So interest rate modeling, etc., is something which we are not going to cover, but VAR is something which we'll cover. We'll complete some bits on volatility smiles as well. But let's see. I mean, credit risk modeling, we can cover basics, because again, credit risk is something which is very quant intensive that way. But the basics are something which we'll target to cover. So
Alright, sir.
once you have those ideas, then I can give you pointers to explore those things further as well.
And the second thing, sir, next week, Monday, Tuesday, Wednesday is our first periodical.
Okay. Okay.
So, sir, if it will be an assignment or if it will be a written paper or what will be the syllabus?
Yes, I will let you guys know that. So I mean, I haven't had a chance to talk to Shrikant sir, but something which I'll talk to him.
Okay, thank you, sir.
Yeah. So let me just take the attendance quickly.
Sir, one more thing. On
Yes.
Saturday, I think there is Gudi Padwa.
Okay. Yes.
So we'll be having class.
So I'll ask Shrikant sir if we can reschedule that. So rather than Saturday, if we could maybe have it on maybe a Friday or Thursday something. So let me check with Shrikant sir and get back. So I have to talk on both the things, the format of the exam and also on the scheduling of this. So I'll do that today. Yeah. All right. So take the attendance quickly. So Akash Singh, Achal Jain, Ayush Bhushan, Adesha, Tejas, Ali is present, Anjali Garg, Anmol Sen,
Present, sir.
Arispita Deka, Avni Mishra, Piyushi is present, Sarvesh is present, Bhavya Dan, Cherry Chabra, Dipansha Singh is present, Diksha Chauhan is present as well,
Present, sir.
Gaurav Kadam,
Present, sir.
Gaurav Datir,
Present, sir.
Himanshu Verma is present, Jaideep is present, K. Ayushi is present, Riya Shukla, Kriti Marwa, Mansi Singhal, Mansimran Arora, Manvi Kukreja,
Yes, sir.
here is present, Muskan Garg, Amrita Gaur is present, Neil Dar is present, Nikhil Agarwal, Rasul Sharma is present, Pratik Maheshwari,
Present, sir.
Rashid Tyagi, Rahul Ghosh, Rahul Giri, Rahul Goswami, Raj Aditya Singh,
Present, sir.
Ashi Jain is present, Rishabh Kothari,
Present, sir.
Ruma Keshri is present, Sahaj Manocha, Samiksha Chopra, Rende is present, Shubham Jain is present, Shubham Kumar. Shubham Kumar is present as well. Right? No, Someshwar Verma,
Present, sir.
Smriti Mehrotra is present, Sanika Thakur is present, Vinay Pawar.
Present, sir.
Okay. So our FE class is done. So you guys can leave. I'll quickly take the IB attendance. So I'll read out the names. If you guys are present, let me know. So I'll mark you present. So Ayush Sharma is present.
Present.
Alisha Gupta, Vidhi Anand, Anant Jain, Anish Topeshwarkar, Anjali Sethi,
Present, sir.
Arshada Imam is also present. Okay, Arshada is not there. Barkha Israni, Bhavya Patel, Saloni, Chaitra. Devam Pandey is present.
Yes, sir.
Gauraja is present. Diksha Kalra, Gayatri Narkede, Govind Mittal, Sawan is present. Himanshi Veermani is present. Indu, Ishita Saxena, Kanika Goyal, Karthik Mittal, Khasro L. Laksha Singhal is present. Mahi Rajawat, Mansi Gupta, Matangi Warrior, Megha Parak, Nancy Alawat, Neha Jain, Pratishtha Pradhan, Rohan Bagai, Rohan Poddar, Samita Malik, Shivangi Samwal. Simran is present. Srishti Verma, Anu Goyal, Tarang Kadyan, Kalyani Todkari, Twinkle Karnawat, Vaishnavi Shrotriya, Vanishka Jain, Vibhor, Vidushi Rana is present. Yash Mehra, Arshada and Vidu. Yes, so yeah, Vidushi, I have already marked you present. I think Arshada also, yeah, Arshada, I'll mark you present. All right, yeah, thank you so much. Thanks for joining in, and you have a good day ahead. Yeah, Ayush, I've already marked you present. So,
Thank you, sir.
so I'll see you guys on Wednesday, and I'll have a word with Shrikant sir, and I'll just update you guys on email on the format and syllabus for the exam, etc. And also we'll decide on what to do for the Saturday's class. We can maybe reschedule that a bit.
Thank you, sir.
Thank you. Thank you. Bye-bye.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.